Markets are trembling, cryptocurrencies are sliding, stocks are reeling, and at the center of this financial storm is a decision that's shaken the global economy. Moody's, one of the big three credit rating agencies, has just downgraded the sovereign credit rating of the United States from AAA to AA1. The aftershocks are being felt across markets, from traditional equities to the volatile world of digital assets. Ethereum, Dogecoin, XRP down nearly 3%. But why is this downgrade such a big deal? And how exactly is it impacting the crypto markets? Let's break down the Moody's downgrade, analyze what it means for your investments, and look into whether this is a temporary pullback or the beginning of something much bigger. On Saturday, Moody's, a name synonymous with sovereign risk assessment, cut the United States sovereign credit rating from the pristine AAA to AAA1. That's not just a small tap on the shoulder. That's a clear signal to global investors. The financial engine of the world has a growing crack in its foundation. So what's behind this downgrade? According to Moody's, the decision was driven by three primary concerns. 1. Swelling deficits. The U.S. federal government is running enormous budget deficits year after year, and the trend shows no signs of slowing. Trillions in spending and stimulus measures have added to a mounting debt load. 2. Rising interest expenses. With the Federal Reserve maintaining elevated interest rates to combat inflation, the cost of servicing that massive debt has increased significantly. Higher rates mean higher payouts on government bonds. 3. Lack of political will. Moody's also cited a concerning lack of long-term political consensus in Washington to rein in spending and bring fiscal discipline. In simple terms, policymakers are kicking the can down the road, and markets are starting to lose faith. With this downgrade, Moody's joins Fitch and S&P, both of which have already removed the U.S. from their top-tier credit rankings in previous years. This makes it official. The U.S. is no longer considered a risk-free borrower by any of the three major agencies. The downgrade didn't happen in a vacuum. It instantly triggered a wave of risk-off sentiment across financial markets. In traditional markets, the S&P 500 futures dipped by 0.6% in after-hours trading, a clear sign that investors are bracing for volatility. U.S. Treasury yields jumped, with the 10-year note climbing to 4.49%, reflecting increased risk premiums demanded by bond buyers. But perhaps most tellingly, the ripple effects were swift and brutal in the crypto markets. Three major cryptocurrencies, Ethereum, Ether, XRP, and Dogecoin, each fell about 3% within hours. Now, in the crypto world, 3% may not sound like a massive crash, but in the context of a multi-trillion-dollar industry, a synchronized decline across major tokens signals widespread concern and reactive selling. Even as the broader crypto market tried to stabilize, it held steady at a $3.3 trillion market cap, down from earlier highs earlier in the week. This flattening confirms what analysts feared. The market was digesting the Moody's downgrade and adjusting to new realities. Why crypto reacted? The sentiment factor. At first glance, ye might think, wait a minute, shouldn't bad news for the US dollar be good news for decentralized assets like Bitcoin and Ethereum? Historically, when trust in centralized monetary policy or fiat currencies falters, crypto often rises as a hedge against that uncertainty. But that's only part of the story. Here's the nuance. While long-term concerns about U.S. debt sustainability and dollar debasement often boost demand for decentralized assets, credit downgrades can trigger short-term sell-offs across all risk assets, crypto included. This is what market analysts call a risk-off environment, when fear sets in and traders pull out of volatile positions. Even assets that are typically seen as hedges can suffer as liquidity dries up. This time, institutional traders, many of whom now dominate crypto markets, likely moved quickly to reduce exposure, not only in stocks, but in crypto as well. The result? A coordinated pullback in Ethereum, XRP, and Dogecoin, tokens that often serve as bellwethers for broader investor sentiment. Bitcoin's curious case, interestingly. While major altcoins took a hit, Bitcoin managed to hold its ground around 104,000, a psychological level and a technical pivot that many traders are watching closely. According to Alex Kupcikevich, the chief market analyst at FX Pro, Bitcoin is showing signs of resilience. For now, he notes, sellers have not yet managed to seize control of the market, but this resilience at high levels may be temporary before the next bounce. That's a cautious but significant observation. It means that although Bitcoin hasn't collapsed in the face of the downgrade, there's still considerable pressure near the upper boundary of the current range. In simple terms, Bitcoin may be holding steady today, but the technicals suggest that a near-term dip could be around the corner, especially if broader macro fears continue. Kupcikevich adds that profit-taking is also in play, especially from those who rode the recent upswing in BTC and altcoins and are now locking in gains. The White House response: it didn't take long for the political fallout to begin. Spokespersons for President Donald Trump wasted no time in responding to the downgrade. They criticized Moody's, calling the move politically motivated. That's a bold accusation, but it underscores the larger issue at play. Trust in rating agencies and fiscal governance is now being questioned openly, and whether Moody's acted on economic indicators or political sentiment, the fact remains: the downgrade is now on the books, and markets must respond accordingly. That's all for today's deep dive on Moody's U.S. credit downgrade and its impact on the crypto markets. If ye found this analysis helpful, don't forget to like, comment, and subscribe to our channel. Stay tuned for more expert insights into the world of crypto, finance, and everything in between. Until next time, keep questioning, keep learning, and keep watching the market.